Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for May 12th, 2018. Let's start with the obvious on this weekend's update. Rip and rally to the upside. However, how is this any different than the rally that we saw, for example, back in February after we pressed some of the February lows? Right? That went a little further than most of us had expected. We saw a rally back in March. We've seen a rally back in April, very similarly to the levels that we're currently at. I think one of the key differences, though, here is when looking at this rally back, first and foremost, many of us didn't necessarily expect it. Okay? But in the midst of any degree of volatility, I think you have to expect, okay, some of the most vicious moves happen to be the upside. And before I get to really any specifics, this is the kind of trade that you need, okay, to adapt to and to fully expect in the coming months and the coming years. Again, we're in a rising interest rate environment. Enough said on that front, or that is the interest rate environment front, in previous kind of updates. Nevertheless, in a rising rate environment, you're going to get substantial volatility, which brings me to one of the key areas that I want to discuss kind of in this weekend's update, and that happens to be really redefining how we look at volatility. And, you know, that's a really kind of big topic, a big conversation. When I say redefining volatility, why would I want to redefine volatility? You know, all throughout the course of this week, lots of traders, they would email me, or, you know, they'd be hitting us up in chat, and they're saying, like, would you look at the VIX? The thing has collapsed way back down. Of course, right? In the midst of a rally, we get the VIX kind of collapsing, right? The volatility comes off. But when I say that, I think we need to really kind of redefine how we kind of assess volatility, how we evaluate volatility. It's simply because in the last 7 trading days, the S&P futures, okay, pretty much from low to high, you're looking at about a 140-point range. Now, correct me if I am wrong, but that's a fairly phenomenal move in a 7 trading day window. 140 S&P points we explode to the upside, and yet we're seeing volatility contract and contract substantially. For those of you that speak a little bit of option geek, right? If you're a little bit of an option geek, you know what that kind of quantifies to you? You want to be long gamma. Effectively means you want to buy options, not be selling options in the midst of this really explosive move, because the move, all right, exceeded all of the expectations, whether it was in the SPX, whether you were trading something like Apple, whether you were trading something like Facebook, it didn't matter. This move was a vicious move, again, to the upside. What we're going to explore here momentarily inside of some of the charts is, you know, number one, what we can kind of expect this next week. Number two, specifically what I mean by kind of redefining volatility. Because again, the market movement right now is all about opportunity. Okay? You have to be comfortable with the risk that you currently have on, however, to really take advantage of those opportunities. With that, let's get to some of the charts on this weekend's update. To the charts we go. Let's start inside of the SPX. All right, so I've been talking a little bit about this kind of spectacular move to the upside in really kind of the last 7 trading sessions. If you want to count them, here they are. After a kind of a vicious intraday sell-off, almost down to the 25.90 handle, we exploded in literally, you know, 1, 2, 3, 4, 5, 6, 7 trading sessions. And one of the things I try to kind of quantify inside of this 7 sessions is, you know, really absolute high to absolute low. And again, you're looking at almost 140 SPX points. So why do I mention the 140 points and what's substantial or significant about that? Well, what's substantial or significant about that is these expected moves kind of on a week-to-week basis. And these expected moves, they've been right in and around, okay, the mid-40s. So we'll call this week, and now we're 3 weeks back. That's about a $45 kind of expected move. We'll label this next week. This is right around a $42 expected move. Just this past week we passed through was about a $40 expected move. You know, the irony of that is if you added all 3 weeks together, okay, you're kind of in the neighborhood of the move that we just saw, all right, in the last 7 trading sessions. So this is statistically a wild move to the upside. And yet at the same time as we see this, again, incredible move to the upside, let's deviate for just a second and go look at the VIX. Because this is where everybody's like, that's it, man, throw in the towel. The volatility is dead again. And yet we just saw one of the most explosive moves that we've seen, okay, in really any recent moves to the upside or the downside. And that's, again, when I say I want to kind of, reevaluate the way that I interpret volatility. And that may sound like a little bit strange, but everybody kind of interprets volatility, oh, really wicked move to the downside. Well, in effect, you kind of feel like you got a lot of traders that got short. That's it. We're headed to the downside. We see an explosive move back up. Now, one thing before I go any further over here is, and I was mentioning this in the kind of video segment, is that you need to be able to not only interpret, but quantify and be capable of really sustaining any degree of risk in the midst of some volatility. And if you are short, and specifically if, again, if you kind of speak a little bit of option geek over here, if you are short delta, if you're negative delta, that basically means you have bearish positions on, right? If you short some deltas, you got to be able to withstand the moves to the upside. One of the hallmarks of volatile markets is the vicious moves back to the upside. And this is where I do believe, based on a lot of the emails that I've received, a lot of the comments inside of the chat room, that many traders were just not prepared to sustain this type of explosive move to the upside. And this type of explosive move to the upside even took us outside of the expected move. The expected move this past week was right around $40, as I was detailing a moment ago. And how far outside of it? I mean, here, about 25 points, 25 SPX points outside of what was expected. People, that is significant. And there again, in lies a very substantial opportunity. You have to look at opportunities in markets as being more than just long or short. And there's a lot of times where we're just like, yeah, we think we're going down. Yeah, we think we're going up. And it's easy enough to take a directional bias position. Okay. But one of the areas that I believe that we're still missing here, and that, you got to have, if you're going to really survive volatility and you're going to go after these opportunities, you have to have more kind of in the bag than just, I'm going to get bullish or bearish. Because one of the great opportunities that's afforded us is we've had weeks recently where we've had the ability to sell premium, and then you get, 3, 4, 5 weeks, we stay inside the expected move, and all of a sudden, okay, this explosive move to the upside, this is right now, okay, a buying premium kind of a situation. And we've been flipping and flopping back and forth between, it's been some great weeks for sell side activity in terms of selling options premium. And with the collapse in volatility, this looks like an outright buying, again, of options premium. In fact, with that, it's a perfect time to kind of look ahead to this next week. For those of you, if you do trade a little bit of the S&Ps, and for the most part, if you're not necessarily trading the SPX, people, that is fine. The SPX, this thing is the mother of all products, right? It's a $2,727 product, okay? And it is absolutely unforgiving. If you don't know what that means, okay, you do not want to find out what that means. This thing I used to call the SPX the widow maker, which is the proper terminology for the beast that lives inside the $2,700 product. Nevertheless, okay, the $2,700 product here only has an expected move of just shy of $33. That really stands out. Why? $33? Are you kidding me? We've been moving that on a daily basis. Okay. And that's one of the shocking things, is that just a few weeks ago, we're like, wow, some premium selling opportunities have really arisen. Okay. Volatility gets crushed back. And now we're like, wow, some premium buying opportunities specifically. And again, this is where I think that there's the most opportunity in this coming week. Forget about any of the news that's coming out. Okay. We could spend the entire, 20 minutes together on a weekend update, taking a look at the calendar. Useless at this point. Okay. The important portion right now is to really recognize, like if we go to the spiders, for example, the expected move, again, for the entire week is like $3.30 some odd cents. And it is a primary expiration week. Nevertheless, all right, on a day-to-day basis, this really affords us some spectacular opportunities on the buy side of premium. And the reason I want to spend a bit more time on this than I normally would, kind of on a weekend update, to me, it's the most important aspect right now in this marketplace. And let me give you a just prime example. So we're going to look at the spiders. And the reason I'm going to look at the spiders is I just think it's a more, realistic product for most people that kind of tune into this. So you're taking a look at the spiders and they're trading what? 272 and change, right? Pretty close to 273. And the spiders have now added, right? Monday, they have Wednesday, and they have Friday expirations. It's a party. 3 expirations a week. Can't go wrong with that. But the point I want to make with all of this, okay, we need to reevaluate how we view volatility. I talked about some long gamma. Hey, listen, this is where the rubber kind of meets the road. Why do I need to focus on this is the number one question, right? And moreover, how would I actually trade this? And well, I'm going to show you that. Now, whether you're bullish or bearish this next week, okay, big question mark. Am I going to be a bull? Am I going to be a bear? Okay, it's not really going to matter. And I'm going to show you why right now. So as the week kind of progresses, let's go ahead and pull up Delta over here. Delta, the rate of change of the option for every dollar increment move in the stock. For the most part, let's look at a 50 Delta option. Right here, I'm going to highlight kind of a 50 Delta option. And again, for Monday. So the 50 Delta option, and again, this premium here, it's right around 60 cents, but that premium is going to be substantially lower by the time that we open up on Monday. So if you have just a 60-cent at the money option, this is where I'm going to challenge you a little bit. On a weekend update, I'm typically kind of reviewing stuff, looking at different moves, but I'm telling you, here's the opportunity, okay? You have an option for 60 cents, and it's an at-the-money option, and that option literally expires, for instance, today. Obviously, this option expires on what? Monday, but if the market opened up on Monday and you were just to buy this option for 60 cents, what do you want to have happen? You want the market to move up, right? You want the market to move up. Is the market going to be capable of moving up enough, okay, to pay you back your 60 cents? Oh yeah, and then some. Okay. If you look at this, and it's unusual to say this, but that 60-cent option, there's almost $1.40 of expected move. But let's say things that, they open kind of docile on a Monday morning. You have to realize that the option premium right now has collapsed down so much so that you can be right even 50% of the time in a week like this, and you could still make money. And the reason is when I say right 50% of the time, and this is something I point out for those of you that do trade on an intraday basis, right? Here is a column where I'm saying you're going to be right 50% of the time. Forget about directional bias. If you're wrong, okay, we're going to lose 60 cents. If we're right, people, there's a lot of bang for your buck in here. If you're right, this 60-cent option, for example, could go in the money by how much? Well, there's almost $1.50 move priced into here, so the 273s would be worth just about what? Okay, well, the 272s, then you come over here to the 271.50s. This option could be worth as much, for example, okay, as $1.60. Now, granted, $1.60, of which you paid 60 cents up front. So in this trade, you can have as much as like $1 of profitability. Now, all I'm getting at, and this kind of confuses a little bit of people, but let's assume that the marketplace is capable of moving, okay, at a max distance, is capable of moving about $1.50 a day. So that means these 273s would be worth roughly what these 271.50s are worth, right? So all I'm doing is, again, I'm being very, very conservative in the pricing. I'm saying your 60-cent option could be worth about $1.60, of which you paid 60 cents up front, so you're going to make about $1. So if you're right, you make $1. If you're wrong, you lose 60 cents. Why wouldn't you want to do that trade? And that's the kind of stuff that's going to exist all throughout the course of this week. Because again, as I was saying, and this just to elaborate right back onto the statement here, redefine how maybe you assess volatility. All right. Why do you want to redefine it? Because there's opportunity in them there moves. It doesn't matter whether we're up or whether we're down. And yet, right now, I think a lot of people are focused a little bit on direction. Now, don't get me wrong. My overall stance in this marketplace, and I want to make this abundantly clear, my overall stance in this marketplace is still absolutely bearish, but that is a much more duration take. When I say a duration take, I'm talking about, hey, over the next 3 months plus, okay, you're going to see some wild moves to the downside. Why? Because everybody wakes up one day and realizes, like, I have interest rate, tension. Interest rate tension. It's a new phrase, but it just basically means interest rate risk as the rates start to go up. People get used to the idea of 3% rates, but anytime those bonds sell off and the interest rates spike, okay, the volatility drum is going to be beaten again. And the other aspect I do want to focus on just a bit over here, let's go back over to the S&P futures for a moment. And as I was saying also kind of in the initial video segment here is, like, listen, this rally that we've seen, okay, and this is the current rally right here. How's that any different than, oh, look over here, all right? So there's the rally back in February. We dipped and we rallied right back here in what? Early March. We dipped. Then we had a slow grind and painful grind to the upside here in April. We dipped and we're right back up over here. So who's not to say, like, all right, could we go a little further than here? Absolutely. Listen, this is where you got to have comfortability with the marketplace, comfortability with whatever your positions are. Okay, we're going to rally back up and there will be another bout of volatility. And the next move could be rather violent over here. But you have a lot going on, okay, that causes these rallies. Some of this can be short cover. I mean, listen, we dipped hard, okay? We felt like we're going to fall apart here at the 25.90 level. And right at that point, people are like, hey, I'm going to cover a couple of futures. They cover some futures and away we go off to the upside. And eventually that steam will kind of run out. Hey, here's one interesting thing on this latest rally. Okay, on this latest rally, the volume inside of the S&P futures is rather dead. I mean, totally dead. In fact, liquidity of the overall markets, it has been terrible. Now, with that, okay, again, I really wanted to spend some time looking at the opportunity over here, but what can we kind of expect this next week? Key sectors that you want to focus on, obviously the financials. Okay, I can't stress this enough. If you're not looking at the financials, you're missing the bigger picture, because this really is where a lot of the volatility to this upside in this last move really came from. The financials touched down to 26.50. Okay, they are $2 higher. Yeah, we came all the way up to 28.50. However, all right, in Friday trade, they reversed. You better watch financials early on in the week. Again, watch financials early on in the week. The other reason I want to watch financials is that if you look at the VIX is all fallen all the way back down to 12 and change. The financial volatility, though, is up here, still very close to the 20 handle. Specifically, this is 18%, which equates to about a 55-cent move inside of the XLF this next week. And again, if you look at the XLF, here's an underlying, okay, specifically an ETF that has just been ripping through expected moves. I mean, this is a product that's supposed to move, again, 55 cents, okay, in what, an entire week? Yeah, the only problem, it's been doing that on a day-to-day basis. The volatility lies inside of the financials. Why? Interest rate sensitive. And again, a lot of people have a tremendous amount of focus back into the Nasdaq over here. Well, great. You can have your focus into the Nasdaq. Nevertheless, it's the S&Ps. Okay, it's the S&Ps that are really going to be driving the bus. And what's driving the S&Ps? Those financials out there. With that, one last thing I want you to be looking at as you come forward into this next week. All right, and that has to do with the VVIX. Now, people, it's been a while since we've discussed the VVIX, but this is the volatility of the volatility index. And one of the final thoughts I'll leave you with is that volatility has actually fallen on the VIX itself. Okay, what I would anticipate is that if the marketplace as a whole is about to go through another, okay, period of kind of sell side activity, I think we're going to see some movement very rapidly back up in the VVIX. Why? Okay, the VVIX kind of measures what professional traders are doing to manage their own risk. So if the VVIX starts to pick back up to the upside, for the most part, it means that a bunch of professionals are putting their hedges back on. For the most part, the way I interpret that is, get your helmet back on. We're going back in. I would look at the VVIX kind of day in and day out, because again, I would anticipate it found a floor right around 90 over here. It even bounced earlier in the week. If we're going to go back through another bout of volatility, what would confirm it, again, would be a move up in the VVIX. And you could even see the VVIX getting bought up as kind of a preemptive strike, meaning that they're going to step in and buy volatility in the VIX before seeing some sell side activity. People, there's a lot to think about in this weekend's update. Again, know your risk, Love the positions you got on. Hopefully, most of you are capable of sustaining this most recent upside move because, again, only the opportunities are going to exist if you can handle the risk that you currently have on. Have a wonderful weekend, everybody. Bye-bye.